Hello there. Welcome to Cost and Management Accounting N5. Right. We have got a question paper that we have here, the recent question paper written in June 2023. We want to look at a question on our balance sheet. This is the question, and on June 2023, this paper was on number. This question was on number 4, and it's on balance sheet. The question reads, I'm going to go through the question so that we understand the question first, then we answer the question in terms of preparing the balance sheet required. Right. If you look at the question here, the question reads, you are supplied with the following information that appears in the books of Mongeni producers on 30 September 2020. And then you are given balances that you are given there in the list of balances that we have there. And if you go down the question, we have got a required part, which is the important part of the question. And the required part reads, prepare the balance sheet of Mongeni producers on 30 September 2020. And then let's note that there is an indication there that we should round off all the amounts to the nearest rand. And basically, to the nearest rand represents that we should round to the nearest whole number, basically. So that's where it's also important to take note, right? Firstly, we would want to understand what do we mean by a balance sheet. But basically, a balance sheet is one of the financial statements that are prepared in businesses or organizations. They represent the assets and liabilities and equity of a business, equity being capital. So basically, a balance sheet is a statement of the assets, liabilities, and the capital of a business. And it also summarizes the business or organization assets, equity, and liabilities at a specific point in time. And we'll see that this balance sheet usually it summarizes the accounting equation, and we know that the accounting equation says it says assets is equals to capital plus liability, whereby this side should be equal to this side. And this accounting equation can be presented in 3 forms, whereby we are making, if you make A the sub of the formula, it will be in this form. So this is our first form. Then the second form, we can make C the sharp of the formula, and it becomes C is equals to assets minus liabilities. And in the third form, I would see that we make liabilities sharp of the formula, and it becomes assets minus capital. So basically, when we are preparing this balance sheet, we will be summarizing this accounting equation, whereby we are going to start by listing. So the form that is going to be represented by the balance sheet usually is the first part of the accounting equation, whereby we first list all the assets and then we get the total, and then we go to when you get the total for all assets, it's going to be the first balancing figure. And then we beneath that, we are going to list all equity or capital. So capital, we can also call it equity, or list of capital, a list of capital, and then we beneath that we also list liabilities. Then we add the total for capital plus liabilities. So the total that we are going to get for capital plus liabilities is the second balancing figure, which should be equal to the balance that would have get for total of assets. So that's what we have in terms of a balance sheet. And also, we need to know also the elements of a balance sheet. We know that we have got assets there, and assets basically they are resources of a business, resources owned by the business or organization, or if it's a sole trader, which means one person is operating, the resources that is owned by that one person who is operating becomes capital, right? We also have the liabilities. Liabilities usually we are saying these are the amounts that are being owed by a business to other people or organizations or businesses. We actually summarize them as liabilities. So you're going to see that under assets, we have 2 different types of assets that we have. We've got current assets and current liabilities. Whereby current assets, we are basically saying these are resources that are going to stay in the business for an average of less than a year. When you've got a resource that is going to stay in the business for less than a year, we are going to indicate it as current assets. Sorry, and then for non-current assets or fixed assets, they are going to stay in the business for more than a year. So this is what we are going to do when we are going to make this preparation of this balance sheet. So on the preparation of the balance sheet now, we are going to first list the assets that we have. So we can go up there to try to identify which assets do we have in the business. So firstly, we are going to list the assets as we are indicating, but on listing these assets, we are going to start by non-current assets. We are going to start by non-current assets. So basically non-current assets. So we're just going to list the figures beneath the year, and then we go and enter them in the balance sheet. Right? For the non-current assets, as we are saying that these are resources or properties that are going to stay in the business for more than a year. So you see that cash becomes a current asset. Cash becomes a current asset, so it's going to stay for less than a year. Trading stock also is a current asset. Data control represents a current asset, and then creditors control is a current liability. Then we go to a bank, becomes a current asset. Also, land and buildings, these are properties that are going to stay for more than a year, so they become non-current assets. So we've got 185,000 here, and then we also have equipment. We understand equipment, the duration of stay in the business obviously is going to be more than a year. Then it also comes here as a non-current asset. Then also have vehicles. You understand vehicles stay on average more than a year again. So you're going to put it here again. Right. Having listed this now, we can make in addition to get the total that we have. So if you add 185, you add 55,000, then you add 60,000. Here you are supposed to get 300,000. So this is the figure for non-current assets that we are going to put. Remember, we are not going to list them individually as this one is representing land and building. Then we list again equipment. We are just going to put the total, which is 300,000. So we go to our balance sheet. So we've got our balance sheet that we have here. So we start by the heading of assets. We start by the heading of assets, and we are going to start with non-current assets. So here we're just going to say non-current assets. And we know that non-current assets, according to the calculation that we had there, we calculated property, equipment, and vehicles. So land and buildings becomes the property. So we can just summarize here is property, equipment, and vehicles. So the non-current assets that we have got property, equipment, and vehicles. Property, equipment, and vehicles. Right. Then we are going to input the figure total that we got there. That was 300,000. Right. So this is going to represent the total for non-current assets that we are going to put here. Remember, these are tangible non-current assets. We can also have intangible non-current assets. For example, we can have a fixed deposit. It becomes an intangible non-current asset. We are supposed, if it was there in the question, we are supposed to put it here, and then we the total for non-current assets. Now we put them here. So here we've got only tangible. So the total that we are going to have there is going to be obviously 300,000. So we're going to put here 300,000, indicating now the non-current assets that all the non-current assets that we have. Right, that is what we have in terms of non-current assets. Then we also have current assets. Remember, we said we are going to list all the assets here. So we also have current assets. Right. So for current assets, again, we check in the question, what do we have? We can go back again and try to see what we have in terms of current assets. So, right, for current assets, let's just indicate there. We are going to start from top. Remember, we said these are resources that are going to stay on average less than a year. Cash float, this is basically petty cash, and it represents a duration of stay of less than a year. So this one becomes one of them. And then we also have trading stock. It's also a current asset. Then we've got debtors control. represents a current asset. And then creditors control is a current liability. We skip it. Then we've got bank. Bank also a current asset. And then we go down to see landed buildings and then we go equipment, vehicles, drawings, then capital. So these are the current assets that we have there. So we are supposed to add 910, we add 7,500, we add 15,200, then we add 7,400. So when we do that, let's just try to add 910, then we add 7,500, then we add 15,200, then we add 7,400. So if you add correctly there, you are supposed to get 31,010. 31,010. So on current assets, we are going to list item by item in terms of we have got stock, trade and other receivables. So the classification that we are going to make in terms of the current assets, we are going to have our trading stock represented on its own. Our trading stock will be represented on its own, and then we have got trade and other receivables. Basically, trade and other receivables, trade and other receivables. Trade and other receivables, basically, we are saying we are going to take the figure for debtors control, these ones, and other receivables that can be there. So other receivables that can be there, we can have prepayments of expenses. We include them under trade and other receivables if they are there in the question. And of course, also accruals of income also, if they are there in the question, we can include them under trade and other receivables. So those are some of the receivables that we can include there. So this is what we have, but in the question that we have, we do not have those items. So we are just going to say trade and other receivables figure is only represented by the debtors control that we have, which is 15,200. And also the debtors control represents those customers that we sold goods to on credit. So they become our debtors, they owe us money. So they are our debtors, and we expect them to pay that amount or that amount due within a period of a year. So that's why we are classifying this under current assets. So that's what we have there. So also, we are saying we have elements of current assets as a trading stock, trade and other receivables, and also we are also supposed to have an element of cash and cash equivalents. Here we are just summarizing all the cash resources that we have in the business. For example, we've got money at the bank, we've got the cash that we have maybe in the cash office. We are going to include it there, and then we've got also petty cash also that we are going to see in the cash office. Also, which is being represented by a cash float. So for cash and cash equivalence figures that we've got the cash float figure, which is 910, and then we add the bank figure that we have, which is 7,400. There, so if we add there, let's try to add. We are saying 910, then we add 7,400. So we're supposed to get 8,310. So 8,310 now represents our cash and cash equivalents. So that's what we have. So we are just going to summarize that one on the answer section. So if you come here now, we are now summarizing what we in terms of current assets. We said we are going to have one of the elements is going to be trading inventory. We'll just call it inventory. So another name for inventory is stock. We just mean the same thing, and the figure that we have there is 7,500, and then we just put it in this column. And also we are going to have trade and other receivables. Trade and other receivables. And remember, we said we only have one element of this one. We have got the debtors control, which is 15,200. So we just put 15,200. Then we have cash and cash equivalents. Cash and cash equivalents. So on cash and cash equivalents, we added that figure that we got for bank, which is 7,400, and then we added cash float for 910. And then the figure that we got there was 8,310. So that's what we have in terms of current assets. And obviously we add now this one, 8,310 plus 50,200 plus 7,500. Then we get the figure for current assets and we put it here to represent that it's what's the total for current assets. So we added that one and we got 31,010. So here we put 31,010. And then we have now listed the elements of assets. We've got done current assets and current assets. They are here. We have now the totals there. So we can now be able to add the two to get the total, for current assets, so that we get the first balancing figure. So if you come here, it means now we are now adding. Here now we add 300,000 plus 31,010, and we are going to get 331,010. So this is the total for total assets. So basically, this figure now represents total assets. So that's what we have in terms of the first balancing figure. So we can close it there to show that this is our first balancing figure. This one becomes our first balancing figure. Then we go to the second part, or we are going to the other side of the equation. Remember, we said the accounting equation says assets is equal to capital plus liability. So beneath this now, we are now listing the capital and the liabilities. Then we get the second balancing figure. So beneath here, we are going to have equity and liabilities. And we, remember, we said equity also means capital, equity and liabilities. And then we list the, we start with capital, which is equity. Right, if you go back to the question now, we try to find out what the figure for capital do we have. Right, this is, we are seeing that we have the figure for capital is 264,210, but this one is not going to be the figure that we're going to put there, because this is representing opening capital, and what the figure that we want is closing capital. So we need to put a formula first that summarizes the statement of changes in equity of a sole trader, of a one person that is operating a business, so that we can be able to find the figure for closing capital. So to find the figure for closing capital, let's try to see. To find the figure for closing capital, we are going to say here, let's come here. So closing capital, we get it by saying opening capital, we add profit. If there's a profit for that financial period, we add the profit. But if you don't have a profit, maybe because the business might make a profit or might make a loss. So if it's a loss, we are going to subtract loss here. And then we also add additional capital. If it's there in the question, maybe during the year, the owner introduced more capital or more resources for the operation of the business, then it becomes additional capital, then to increase the value of capital. So this is we add the additional capital. Then if there are drawings, again we subtract drawings. Then now we get the figure for closing. That's the figure that we've indicated there. So then when we do that, we now find the figure for closing capital. So we can go back again according to the information that we are given in the question and try to see how we can find that figure. So here our opening capital is 264,210, and our drawings we've got 6,500, and then our profit for the year is given at the beginning there is 60,000. So we are going to say opening capital, we add profit, then we less drawings, then we get our figure for closing capital. So opening capital is 264,210. Then we add our profit, which is 60,000. Then we less our drawings, which is 6,500. So when we calculate it as it is, we are supposed to get 317,710. Right. So this is the figure that we are going to input as capital there. Then go back to the answer section. And we are going to see that our figure for capital is 317,710. So we are going to put it here, 317,710. So now we go to the, remember I said capital plus liabilities. So we go to the liabilities section. We are going to start with the non-current liabilities. Remember, we said we have got two again types of liabilities, which is current liabilities and non-current liabilities. So we can start with the non-current liabilities. Usually they come in the form of loans or mortgage loans. Long-term loans also are going to be included there of non-current liabilities. We might also have short-term loans, which will include under current liabilities. So here, according to the question, we can go back to check if we've got such elements. We go there, we see that we start from net profit, go down. We see that we have no loans that are there to represent non-current liabilities. So we can just skip that that section of non-current liabilities and leave it blank. Then now we go to current liabilities. Right. So for current liabilities, remember also we had the figure for trade and other receivables under current assets. So the same we are going to do for current liabilities. For current assets, we had the figure for trade and other receivables. So here for current liabilities, also you should have the figure for trade and other payables. Trade and other payables. And also in the question, if you have some short-term loans that are there, we include them under current liabilities. We might also have, if it's in the form of a company, we might also have current liabilities coming in the form of checks, which are supposed to be included there, but we don't have such elements in this question. So here, we can have trade and other receivables. And so trade and other payables. In that trade and other payables, also, the first element that is there is we have got the creditors control. It's one of the key elements of the trade and other payables, which is here, trade control. So we'll see that other payables that might be there, we might have accrual or owings of expenses. We include them as payables. And then we might also have prepayments of income. We also include them as payables. So if they were there in the question, we're supposed to add them there to the figure of 13,300 to get the total for trade and other payables. But if you look in the question, we don't have such. So we are just going to put this figure that we have 18,300. So we go back there. We have current liabilities. Obviously, we are having trade and other payables. Trade and other payables. And the figure that we have is 13,300. Right, the figure is 18,300. So we're going to put it here. And remember, that's the only figure that we have. So it represents our current liabilities. So we're going to put here again 13,300. Right, so that's what we have for the second part, which is of equity liabilities. Then we now add the figure for capital plus the figure for current liabilities. Remember, here we don't have anything for non-current liabilities. So we add the two to get the second balancing figure. So if you add 317,710 plus 13,300, you're supposed to get 331,000. 331,010. So this is the scenario that we have. And remember, we said this represents the counting equation whereby say assets is equals to total assets is equals to the total for equity and liability. So we are seeing that these figures are the same, meaning we've correctly prepared our balance sheet. So that's what we have on the first part. Then we can go to look at the second part of the question. Right, the second part of the question is here, and it's saying you are the cost accountant of Gadibeng manufacturers, and we were requested by the insurance company to calculate the average stock destroyed by the flooding at the warehouse. You receive the following information. So you've got the order size calculated the previous month is 90,000 units, and you've got safety work according to the costing department is 9,000 units, and you've got order point 10,600 units. Then on the required part, the question reads, determine the average stock that was destroyed by the flooding at the warehouse. Show the formula used. Right. Here we are calculating, what is important there is what we are calculating. So if you come here, you would see that we are calculating average stock that was destroyed. So here, that's where the question is, average stock that was destroyed. So to calculate that one, the formula that we are going to use is average stock. Average stock is equal to order size. We say order size over 2, and then we add safety stock. Then we add safety stock. So here now we add safety stock. So remember, the question is emphasizing on the formula, that we should show the formula. So this is what we have in terms of the formula. So if you see the order sizes here, which is 90,000, you divide it by 2, then we add the safety work, which is given here. The safety work, let's try to see there. Right, the safety work is here. They're saying safety work according to the costing department, 9,000 units. So that's our safety work. So we add 9,000. 9,000. So basically, when you say 2 into 90,000, you get 45,000. You get 45,000. Then you add it to 9,000. Then obviously, when you do that, you are going to get 54,000. So that's what we have in terms of the average stock. So that is what we have, guys, in terms of the question 4 in June 2023 question paper. So please stay tuned for more videos to come as we prepare for our final exams. Those who haven't subscribed, please subscribe and share. With that, we'll meet again in the next video. Videos are still coming, so stay tuned. With that, I'm out, and we'll meet again.